Okay, I think we're about ready to begin. Welcome everyone to our webinar, Your Guide to the Verizon Pension Benefit. Thanks for joining us this evening. I'm Casey Gibb, Managing Director of Financial Planning at H&A. With us today are two of our financial advisors, Christina Hapanowicz, CFP, who sits on both our financial planning and investment committees, and also Bobby Hapanowicz, who helps lead our investment committee. So welcome again. For over 2 decades, we at H&A have been delivering worry-free retirement for folks retiring from Verizon and other large companies. It's really what we excel at. So thanks for joining us. Christina, do you want to say a few words?
Yeah, thank you everybody again for joining us. We're excited to have you guys here with us today for this presentation. As Casey mentioned, we have been working with specifically Verizon Associates for over 20 years now. With that being said, something we want to make sure everyone knows is that we are not affiliated with or endorsed by any specific company or corporation, including Verizon. And that's actually a good thing, because what that means for you, everyone who's listening in today, is that we are in the position to give conflict-free, unbiased advice to you that is extremely customized and individualized to you and your family, and in your best interest as well, not just today, but down the road for the entirety of the relationship that we might work together for. So again, just want to make sure everyone knows that. Now, that being said, we have worked with many Verizon associates and managers, and the topic that we want to cover today is something that we have helped associates and managers with for many years, and that is the Verizon pension benefit, specifically the choice between the annuity payout option and the lump sum payout option. It's one of the most important decisions an associate or manager could probably make in their path to retirement. And what we're going to do is talk about what that Verizon pension benefit is. We're going to go through the pros and cons of each of those choices, the annuity versus the lump sum. And we're also going to talk a little bit about how we think you can go about making that important decision when you do decide to retire. So let's first get into what a pension actually is in general. Most of you guys probably already know this, but we'll just cover the highlights. So a pension is one of the many retirement benefits that you could participate in as an employee of a large company or corporation. Opposite from a 401k plan, which most of you are probably participating in and contributing to, a pension works a little differently. The funding of the plan is entirely on the employer. So in this case, Verizon. Verizon is making all of the contributions and you are not making any contributions. In addition to that, the investing and managing of that plan does not lie on you. That is all done by Verizon as well. So you do not need to manage anything, and it's a benefit that's paid out to you at the commencement of your retirement. And that benefit goes into whatever account you wish it to go into. Something else that we think is really important you guys are aware of is that you're able to select beneficiaries for your pension benefit. So we recommend at least once a year that you review those beneficiaries listed on your pension benefit. Also, in addition to that, your IRAs, your 401k as well. We think that's something that's really important that you review at least once a year. Now, those are the general topics for a pension benefit, the general points. But let's get into specifically how the Verizon pension benefit works. Bobby, do you want to talk about that?
Absolutely, Chris. Yes. So to start, any associate who joins Verizon before October 28th, 2012 is entitled to a pension benefit. And there are some pension eligibility and vesting requirements at Verizon that can affect the value of your pension that we'd like to go over. And we'll start with the eligibility. We call this the 75 rule. And by that, we mean your age and your years of service numbers have to at least equal 75, if not more, starting at age 50 and working up in increments of 5 years of age. So you can see here at age 50, you have to have at least 25 years of service. At age 55, you have to have at least 20 years of service, and so on and so forth. With the caveat that if you have 30 years of service, no matter what age you are eligible for the service pension. Now, with that in mind, an age discount might apply if you take what Verizon deems to be an early retirement. and they define that as retiring before age 55. And if you do so, there is a 0.5% per month age discount for each month under age 55 from which you retire. So 1 year is equivalent to 6% of an age discount. And again, that 30 years of service number is really important, because if you have 30 years of service, regardless of your age, there's no discount applied to your pension benefit.
Mm-hmm.
So that's a really important point. And one more important point that really differentiates Verizon's pension from many other employers' pensions, especially in this day and age, is the fact that when you are ready to elect your benefit, you have the choice between an annuity or a lump sum form in electing that benefit. And that's actually, of course, a subject of the rest of the webinar here. And with that in mind, Casey, would you like to start by discussing the annuity benefit?
Yeah, sure. Yes, that annuity option, that's your fixed monthly pension paid over your lifetime or over possibly 2 lives if you're choosing the joint survivor option. So for the associates, the single life annuity payment is based on 2 factors: your pension band factor, which is unique to your job title, and also your years of service. You multiply those 2 together and you get your monthly pension based upon your life only. So it's a fixed payment. It doesn't inflate over time. It's fixed. It's paid over your lifetime, or like I said, over 2 lifetimes if you choose a joint survivor. For managers, that pension annuity benefit was frozen back in 2006. It wasn't taken away. It's just static. It's frozen. It is what it is. And it's not growing as such with the associates. It's a little bit different flavor of that fixed annuity for the managers.
Mm-hmm. Okay, so that was the annuity option. Let's talk about that second option, the lump sum distribution. So it works a little differently, of course, from the annuity. And it's exactly that. It's a lump sum distribution paid out to you upon the commencement of your retirement from Verizon. So it's one big payout, and it's meant to be the equivalent of the present value of all those future payments that you would have received if you were to elect the annuity option. So it's really based upon what that monthly benefit would be if you were to select that annuity option. It's also based upon a couple of additional factors as well: your life expectancy, and probably what many would consider the most important or the most significant factor is interest rates. So depending on if you are an East associate or a West associate or a manager, 1 or 2 or all 3 of these interest rates we'll get into in a little more in the next slide. But a different combination of these interest rates are used to calculate what that lump sum payout would be for your pension benefit. So that lump sum, again, is paid out to you from Verizon into the account, into the location of your choice, and that entire benefit becomes yours and is on your balance sheet. So let's get into a little more how those interest rates work and how that relationship is with that lump sum payout. Bobby, do you want to talk about that?
Sure. So Christina just mentioned the importance of interest rates in calculating your lump sum benefit. And the reason why they're so important is because they directly affect it in an inverse way. By that, I mean, as interest rates go lower, like they are right now, pension lump sums increase in value. And the reverse is true as well. When interest rates increase, your pension lump sum value will decrease. And so that's very important. And you can see here on the left side of the screen what the third quarter 2020 interest rates are today for West associates, East associates, and managers alike. Again, as Christina said, either one of these or any of the 3 for managers will be used to calculate your interest rate. Whatever one will result in the highest cash out option for you. But these rates do change for managers as frequently as monthly in some cases. And with that, lump sums can be very interest rate sensitive. So Casey, would you like to show everybody just what kind of dollar effects interest rates?
This is a good example. It's just a sample, but the slide shows a 55-year-old with a $1,500 monthly pension and what the lump sum equivalent would be over different interest rates. And you can see as rates have decreased over the years, the last 20, 30 years, from 6% down to 2% or less, as we've seen, the lump sum has increased significantly, dramatically.
Mm-hmm.
Today, like Bobby said, we see the PBGC rate at 0%. the GAT rate at 1.3%, and these are historic low rates, which are very beneficial to the associates and managers retiring today, or probably even in the next couple of years.
Absolutely.
We've been advising associates and managers for over 20 years now and just never seen these drastic low rates as we see today.
Absolutely, Casey. And again, this is just an illustration, this does show just how much a change in interest rates can affect your lump sum value. And given that, again, some of these rates can change as frequently as monthly, most of them quarterly, it just shows how volatile that lump sum benefit can be, which begs the question, when should you start following interest rates and how frequently should you monitor them? And we typically recommend that people start, you can always be aware of them as you're an employee of Verizon, but particularly when you're 12 months away from your expected retirement date and closer, we recommend that you start checking them at least quarterly, in some cases more often, like as frequently as monthly. And so that's very important, again, because of the volatility that there can be in your lump sum benefit. Say you're expected to retire in the fourth quarter of this year, but you see that first quarter rates are lower. Well, bumping or third quarter rates could be lower as well. Well, bumping up that retirement date a few months could result in a larger lump sum value. And, trading off only, a couple of months worth of salary for that higher lump sum value can make a lot of sense. Does it make sense to bump up your retirement 3 years and lose all of that salary for a higher lump sum? Not necessarily. There's a lot of factors that go into choosing that retirement date. But again, the closer you get to that retirement age, the more important it can be to monitor those interest rates.
Mm-hmm. Yep. All good points. And so what we did was we defined what the annuity option was and what that lump sum option was. In our opinion, before a decision should be made between the annuity and the lump sum, we think we also need to look at the pros and cons between both of them. So let's do that now. For the annuity, let's start off with the pros, which I can speak to. So that first pro that you see on the left of your screen, income for life. So as financial planners, we, in our opinion, this annuity benefit can be considered a guaranteed income source. Of course, nothing in life is ever guaranteed, but just like your Social Security benefit, an annuity benefit, an annuity pension benefit can be considered a guaranteed income source when you are doing your retirement planning. In addition to that, you also have some flexibility in terms of the longevity of that benefit. You can choose to have that benefit last over your lifetime or over your spouse's lifetime as well. And within that option, there are several different options as well. So you have some flexibility. And then that third pro is the burden of managing those investments is not on you when you decide to take that annuity benefit. It lies entirely upon your employer, in this case, Verizon. Now, with those three pros, I feel it's really important to consider the corresponding risks and considerations that come with those pros when you are choosing between, whether or not you want to go with the annuity option. So, Casey, do you want to speak to those considerations?
Sure. Thanks, Lynn. Yeah, there definitely are some disadvantages. The primary one would be the loss of purchasing power over time due to inflation. Inflation is really the enemy of a fixed annuity, fixed pension over time. For example, just a 3% inflation rate reduces your annuity buying power by about 50% over 24 years. And we expect most people to be retired at least over 24, 30 or plus more years. So it does affect your buying power with that annuity. Secondly, you cannot transfer any benefit to your heirs other than possibly your beneficiary receiving the joint survivor option. After that, it's done. It's a finished payment. And with that, there's less flexibility with the annuity option. It's a monthly payment, pure and simple, not on your balance sheet. It stays with the pension and with the company. And finally, a concern for a lot of folks is the financial health of the pension plan. Granted, Verizon is currently in a very good financial condition, but down the road, that's an issue. If they get bought out, if there's a merger, consolidation, things of that sort, things could develop.
Mm-hmm.
Today, the financial health of the pension is fine, though the future is unknown.
Okay, let's talk about the lump sum. Let's get into the pros and cons. Bobby, do you want to speak to the pros?
Absolutely. Great points, Chris and Casey, on the annuity. And to juxtapose that with the lump sum, there are several benefits to electing that lump sum, and they all revolve around the greater flexibility that you have when electing a lump sum. So when you do elect the cash out lump sum benefit, that entire asset is on your balance sheet now. Whereas if you take the annuity option, that's still an asset on Verizon's balance sheet. So now that it's on your balance sheet, you have more flexibility in how you can use those assets. If you want to pay off a mortgage immediately at the onset of retirement, you can use that lump sum value to do that. If you want to put some money aside for a vacation for you and your family, you can do that as well. There's more flexibility. And with that, another example would be that you could pass on whatever is left that you haven't used to heirs. So there's more estate planning flexibility with that. You wouldn't have that option if you chose the annuity. And as Casey and Christina mentioned, with the purchasing power depletion, if you use the annuity, because it's a fixed amount that you're taking out for life, you can start with conservative withdrawals from your lump sum distribution. And if those assets are managed well, you can increase those over time. There's a potential to increase those over time to keep pace with inflation. So that means as you progress later and later in retirement, you're less likely to have to adjust your lifestyle, which of course is a very important goal for most people in retirement. But with that, there is one important con that Casey, if you'd like to discuss.
Oh, sure. Yeah, that is, it can be an unfortunate event. Your retirement money could deplete before you die if it's not managed properly. And, that's the case for some folks. That's why we feel it's so important more than any time in your life to have a financial advisor providing professional management of your investments. During the accumulation stage, you're probably investing in 401ks, IRA accounts. You have some flexibility there because time is on your side, but in retirement, in the distribution phase, professional management is of utmost importance, we feel.
Mm-hmm. Yeah, that's so true. And we truly cannot stress that enough. We really highly recommend that you work with your advisor when making that decision between the lump sum and the annuity, in addition to having any sort of investments managed properly over a long period of time. You really just cannot go wrong by working with an experienced and credentialed advisor and advisory team. The decision between the lump sum and the annuity is extremely personal, and it should be a customized decision. But it shouldn't just be based on the math between the annuity payments and the lump sum payments, in our opinion. In our opinion, we think that that decision needs to be made within your total financial plan, your total retirement plan, and your cash flow plan as one piece of that entire puzzle. So, a lot of considerations should be taken into account, and some of these are listed here on the screen. I'll read them out loud. Again, your personal financial plan. What are your income needs in retirement, and what are your projected expense components? Do you have any other guaranteed sources of income that you will be able to rely upon in retirement? What is your life expectancy? What do you want your financial legacy to look like, not just for your spouse or partner, but also for your next generations as well? All of these and so many more should be taken into consideration when making this decision. It's a decision that we have helped a lot of associates and managers make over the years. And to clarify, what I mean by that is we don't tell associates or managers when we work with them which one to choose between. What your advisor will help you do is lay out all of the information and help you come to that educated decision. But that decision is your own to make. Again, it's a highly personal one. In our experience, over the last 20 plus years, we can say that the overwhelming majority of associates and managers do go with the lump sum payment option for many different reasons. But again, please do reach out to your advisor. If you don't have an advisor, please use us as a resource. That is a no strings attached offer. We hope you guys will reach out to us. We're going to get into some Q&A, but before that, Casey, do you want to round us off here?
Okay, sure. Yeah, I agree, Chris. That personal financial plan makes both the retirement decision and the decision to whether to take the annuity or the lump sum so much easier. So we're all about planning first. In fact, one of our favorite quotes at the firm is, "A well thought out and executed plan stands the test of time." So at H&A, we've all been about planning first, helping you answer the question, am I on track for that worry-free retirement?
Yeah, absolutely. Okay, so I should have mentioned this at the beginning of our presentation. We already do have a couple of questions submitted, but if you do have any questions, please do use that Q&A box, which will either be at the top or bottom of your screen, and we hope that we'll get some more questions from you guys, but we have a couple here. So the first is, I am 54 and have 28 years of service as an associate. How much of a pension reduction would I have? Casey, do you want to take that one?
Sure. Yeah, that goes back to what Bobby was talking about and stating that with less than 30 years of service, this individual has less than 30 years of service, there would be a 0.5% per month pension reduction for every month prior to 55. So that's 12 months times 0.5%. That's a 6% reduction in the pension benefit for that person aged 54 or 54 with 28 years of service.
Okay, great question. Let's move on to the second question we have. I plan on retiring within the next few years. Should I retire now with rates so low? Bobby, do you want to take that one?
Yeah, that's a great question. And, it's a personal question. There's a lot of components that go into choosing a retirement date. The one thing I can say is to certainly try to make that decision in the broader context of your financial plan and your retirement plan. Having said that, there's there's trade-offs that go into choosing to retire several years earlier that we discussed before, such as you're trading off the salary that you would have made in those few years if you would have kept working. Now, if you're trading off 3 months worth of salary, that might make a lot more sense than if you're trading off 3 years worth of salary. And on top of that, the savings that you could have continued to accrue for retirement as well. But again, that's a great question. It's very important to monitor those interest rates and be aware of those and be on top of those. And, I'm actually happy that question came up again, because something that I meant to mention is when you're monitoring those interest rates periodically, that's something we can actually help you with. We have a pension memo update, a pension rate update that we send out quarterly. So if you're not getting those already, certainly sign up for those. You can reach out to Casey, Christina, or me through our email or phone number, or if you just want to put your name in the comments section below, or just let us know that you'd like to be on those, we can make sure that you're getting those. But those are very important. We send them out to West Associates, East Associates, and managers. So certainly watch out for those as well. But going back to your question, that's a great question.
Okay. Yes, that was a good question. Okay. Next question. I am an associate and will probably retire sometime within the next 2 to 3 years. There is always a rumor the lump sum option will be taken away. Should I be concerned about this since the current contract expires in 2 years? Do you want to speak to that?
Oh, sure. Yeah, you're right. That rumor mill starts going pretty active right about contract time. And taking the lump sum option always seems to be just that rumor. So you have to be careful you don't get into the rumor and displace or interrupt your financial plan. We believe that probably Verizon wants to retain that lump sum option. It's a means really of taking the pension liability off their books, administratively and cost-wise. So it seems like that rumor of a lump sum going away is just that, a rumor. It seems like management uses it as a negotiation ploy.
Yeah. And, just to speak a little more to that, and Casey, correct me if I'm wrong, but worst case scenario, if the lump sum option were to be taken away, as financial planners, is that necessarily the end of the world? No. Is it a huge inconvenience? Yes, if you were planning on taking that lump sum distribution. But, as planners, what we do is we build out an initial game plan, and as circumstances change and as life happens, then adjust the plan accordingly. That financial plan, that retirement plan, is meant to be a living, breathing document. It's not meant to be stagnant. So if some sort of circumstance were to change, whether it's that example, that lump sum distribution being taken away or anything else, talk with your advisor and they will work with you to adjust that game plan accordingly. Okay, great question. It looks like we have one more question, but if any of you tuning in today, if you think of any more, please do submit them here. But we have this question: what are the tax implications of both options? So the annuity option and the lump sum distribution, which is a very good question. And the tax implications should be a huge consideration. Casey, do you want to start us off in answering those?
Yeah, I think the lump sum option, normally folks roll it over into an IRA account. It's a tax-free transfer of assets. It reaches the IRA account. It builds up tax deferred. It's not taxable until somebody starts taking a distribution out of it.
Mm-hmm.
You know, the annuity, it's a payment, which is federally taxable. And
yeah, I mean,
the annuity has more of an immediate tax effect.
Yeah.
The IRA rollover from the lump sum.
Exactly. Yeah. I mean, you could even consider that from a financial planner's perspective. I would consider that a pro for the lump sum option is that you have more flexibility in terms of the tax implications. As long as you roll it over into an IRA or a tax qualified account, you have more flexibility in terms of when you decide to take on those tax implications, because it's based off of when you decide to start taking distributions and how much of distributions you want to take. So great question. Okay, we have another question. What kind of IRA should I use to transfer my lump sum into? Well, that would be a rollover IRA. Isn't that right, Casey?
Yeah, it would be a traditional IRA rollover account.
Mm-hmm.
You know, from there, if you want to convert a portion of it into a Roth, you could, but the immediate IRA would be a traditional IRA account.
Yeah, I mean, you can choose to do whatever you want with that money. If you take the lump sum, you could put it all into your checking account if you wanted to. That's usually not something we recommend you do because of those tax implications. The rollover traditional IRA is, you know, the overwhelming majority of the time, the account that we see a lump sum transferred into. But as Casey mentioned, you know, from there you can convert it into a Roth. That is your money now, so you can do with it whatever you please. Exactly what you should be doing is, again, a personal decision. So what we describe now is what the majority of people do, but, you know, in full disclosure, that particular answer for you, for this individual asking that question, it might be, you know, a little different depending on your circumstances, your situation, and what you want to use that money for. Okay, I think that is all the questions we have now. I do see that a few of you are calling in today. So just so you're aware, we're going to be sending out the recording of this webinar to everyone who attended. So if you would like to watch this back with the slides as well, you know, over your morning cup of coffee, you know, you're welcome to do that. Please look out for that email from us over the next day or so. You can see our phone number at the bottom of the screen, 412-261-5966. Our emails are also at the bottom of the screen here. And if you think of any additional questions that you might have or want to discuss any of this in further detail, especially how it might pertain to you specifically, please do reach out to us and use us as a resource. You know, again, we've been working with Verizon folks for over 20 years now. So we've seen it all, and we would love to have the opportunity to help you out. Please do look out for more emails from us throughout the rest of the year promoting additional Verizon webinars. We're going to be covering some more specific items relating to you as a Verizon associate or manager. So we'll be, again, sending that out through email. And thank you so much for joining. We really appreciate it. And have a great evening.
Thank you.